This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Win streak snapped. Stocks take a breather from their record run as investors gear up for a very busy earnings week. Retirement crisis. 401k plans may be safe for now, but that does not change the fact that many Americans have little saved for their later years. New bellwethers. You know, GE used to be one, but there may be other companies that better reflect current economic trends. Those stories and more tonight on Nightly Business Report for this Monday, October the 23rd. Good evening, everybody. I'm Bill Griffith coming to you tonight from the New York Stock Exchange. Both Tyler Matheson and Sue Herrera are off tonight, so it's just you and me. Let's do this, shall we? Here on Wall Street, stocks pulled back from record levels to start this week. The Dow snapped its six-day win streak as shares of General Electric weighed on investor sentiment and saw their biggest decline in 6 years. We'll have more on that story in a moment. But first, the closing numbers. The Dow did hit an intraday high today in record territory, but finally fell 54 points at the close to 23,273. The Nasdaq was down by 42 points. The S&P fell by 10. The prospects of tax reform has long been a big driver for this stock market, but one tax proposal that got a lot of buzz over the weekend was changing popular 401k retirement plans. That's likely not going to happen, but the president this morning tweeted there will be no change to your 401k. This has always been a great and popular middle-class tax break that works, and it stays. There had been reports that Republicans in Congress were weighing a proposal that would significantly reduce the income that workers could save in these accounts as a way to offset lost revenue with tax reform. And all that talk about retirement just highlighted one major problem right now. Most Americans don't have enough saved for their later years. Bob Pisani has the grim details for us tonight.
The dust up over 401ks is a good opportunity to remind everyone how bad the state of the average person's retirement plan is, and cutting 401ks will only make it worse. The good news, the total value of investment in 401ks and other defined contribution plans are at a new high thanks to the stock market rally. The bad news is the numbers are still terrible. Americans don't save enough for their retirement with or without 401ks. According to Vanguard, 94 million Americans are covered by defined contribution accounts like 401ks. Assets are in excess of $7 trillion. Oh, sounds like a lot of money. Well, it is. But when you really drill down, there's not a lot in the accounts. The median account for 35 to 40-year-olds has only 23,000 in, and 65 and over, you only have 60,000. Let's assume at 65 you're going to live another 20 years. 60,000 isn't much to live on, spread out over 20 years. We need personal savings because the contributions from Social Security and pensions are modest. It's about $13,000 a year for Social Security right now, a little more than $10,000 per year from private pensions, but only a third of Americans collect pensions. So private savings are critical for helping people through retirement. But most people don't even contribute the maximum amount to their 401ks, likely because they either can't afford to or they'd rather spend the money. There's been other proposals floated to help investors save money. A universal savings account where investors contribute after-tax money, but the gain on the accounts are tax-free, has been successfully implemented in Canada and the UK. Investors can take out money at any time without paying taxes or penalties. One thing's for sure, if we don't find some way to get people to save more, a lot of people are going to work into their 80s or they're going to outlive their money. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
All right, here to talk more about this retirement crisis and what you can do maybe to maximize your savings. Joining us tonight, Diane Oakley is Executive Director at the National Institute on Retirement Security. Eric Annis is President of Titus Wealth Management. Folks, thank you both for joining us tonight. Diane, I well remember when defined contribution plans were introduced back in the 1980s with IRAs and 401ks. Here we are 30 years later, and we see here that the median amount saved by a 65-year-old today is only $60,000. What happened?
You know, I think what happened is a lot of Americans just couldn't afford to save. We hear from people saying that with their salaries being somewhat constrained and not growing that much, they just can't save enough.
Eric, what do you think? I mean, people are told save a certain amount and then let the money grow. But was that a flawed message to Americans?
Well, people need to start earlier and save longer. That's really the message. And the old school of defined benefit plans where the company took care of you, that just no longer exist. And I think it's all about education and making sure that really people understand what, as Albert Einstein called it, the eighth wonder of the world, compound interest. Understand what you'd have today and what you could end up in the future if you're diligent with your plan.
But what about Diane's point that people just can't afford to save as much as they should right now?
Well, that's a whole nother animal. The end result is you're going to have to do better budgeting. You're going to have to figure out where you can make some modifications to your budget and make hard decisions if you do indeed want to reach your retirement goals.
Diane, the current cap now for a 401k to be for you to save is what, $18,000 a year? Is that what it is now?
Yes, it is.
And they were talking, I don't know, they still haven't taken this back yet, that maybe reducing that sharply to $2,400. What would that do to the average person saving for retirement right now?
You know, the average person just doesn't have that much to save as it is, and if you cut that back so much, when they get towards their later years where maybe the kids have gotten through college and they've got an ability to save, and they could finally max out. If they're going to max out and the new max is $2,400 where it used to be $18,000, it's hard to catch up for what they lost over those years. You know, people today tell you you've got to start in your 20s saving 15% of your pay. If you don't do that until you're 35 or 40, you've almost got to do 30% of your pay. And most people can't afford their bills today and do that kind of saving for retirement.
And Eric, it's been a sort of a double whammy because we can't be saved by the bond market, the fixed income market, because interest rates have been so low for the last decade, and there's no sign they're going to rise that appreciably in the near future, right?
Yeah, that's true, and that's why you really want to reverse engineer your plan, and that comes back to the fact of if I'm 25 or 30 today and I'm going to retire and I'm 65, well, how much do I need to save and what kind of rate do I need to earn? And really taking a look at your time horizon to make sure that you can maybe be a little more aggressive. As you said, you know, fixed income, if rates do rise, it doesn't sound like a wonderful time for bonds. So folks may have to get a little more aggressive.
I suspect we're preaching to the choir with our audience here on the Nightly Business Report. They're very savvy investors to begin with. But, Eric, let's assume we've got a 65-year-old out there who has saved the median of $60,000. What do they do now?
Well, that's a great question, Bill, because the safe and secure method of investing just doesn't exist anymore. You can't get anything at the bank, and if you put it in bonds, the yields are pretty low. So they do have to kind of venture into you know, a bull market that may be kind of in the third or fourth quarter here. So that makes the decisions even a little bit harder. But if your time horizon is long enough, having a diversified plan can still make some sense for you.
Diane, there are many types of plans these days, you know, with the Roth IRAs that are out there in addition to the traditional IRAs, the catch-up IRAs. I mean, is it too complicated for the average person who just doesn't pay that much attention to investments these days?
You know, it is complicated. It used to be simple when Grandpa had a pension plan, and it actually worked pretty well for Grandpa. The real question is, as you're looking at retiring and you've got different products to save, if you don't have it through your employer, it makes it that much harder because you don't have the convenience of having money come right out of your paycheck and go right into your retirement account. And so that's a key and an important thing to make sure that people have the access through an employer. And I think if you go to a low cap, you'd end up taking away the incentive for employers to offer plans.
And quickly before we go, I know some states for small business owners that can't afford to offer a plan of some kind, Oregon, for example, now has these retirement plans much like a college savings plan. Is that a good idea to get into if you can?
It is actually a good, I think a lot of these states are starting to look at the fact of how many people have nothing saved. If you look at the group of people age 64 to 55, those individuals, you've got about 60% of them who have less than 1 times their salary saved. So how do we get people to nudge into retirement savings by having it be automatic like the plan is in Oregon and it is in about 6 other states that are looking to bring these plans on board?
Folks, thank you. Diane Oakley with the National Institute on Retirement Security and Eric Annis with Titus Wealth Management. Thanks for joining us tonight.
Thanks, Bill.
Thank you, Bill.
As we mentioned, one stock weighing on the market today was General Electric. Shares of GE saw their biggest decline in 6 years today. A number of brokerages cut their price targets on the stock, citing higher chances of a dividend cut following that disappointing earnings report last Friday. The stock was off more than 6% on heavy volume. GE was once considered a bellwether for the economy, and whether it still is or not is up for debate right now. But today, some are looking to a new batch of companies that they say are more reflective of the changing times. Dominic Chu has our story tonight.
According to the Merriam-Webster Dictionary, bellwether is defined as one that takes the lead or initiative, also an indicator of trends. Now, trends in the stock market change over time, and so do the bellwethers of the market. In today's environment, it's easy to see Apple as a market bellwether. That's what Jones Trading chief market strategist Mike O'Rourke says. Not only is it the biggest company out there, it's also a blend of technology and retail, which means it could be viewed as an indicator of the consumer. It's why Northern Trust chief investment strategist Jim McDonald says he'd pick Walmart. He says the U.S. is a consumer-led economy, and Walmart is a good measure of consumer spending. Some estimates, of course, have over 2/3 of our economy driven by consumer spending. Speaking of economic activity, Wunderlich Securities chief market strategist Art Hogan says today's bellwether is FedEx. Simply put, he feels like it's impossible to hide economic activity from transportation companies like FedEx, so it acts as a good indicator. And when it comes to a conglomerate, look no further than Berkshire Hathaway. Huntington Private Bank Chief Investment Officer John Augustine thinks Warren Buffett's company has a set of businesses that are basically a smaller sample of the American economy, with everything from insurance to retail to railroads to energy, etc. Now, everyone has a different view on what companies are the best indicators of the market or economy right now, but one thing is for certain. America and its top companies will always have to evolve with the times. For Nightly Business Report, I'm Dominic Chu.
This is the busiest week for earnings, with more than 170 members of the S&P 500 reporting results this week, 12 Dow components among them. And that includes McDonald's, which has seen its stock rise about 35% just this year. And now investors want to know if there's a golden opportunity that could send the shares even higher. Kate Rogers tells us what to look for when McDonald's reports first thing tomorrow morning.
Hurricanes Harvey and Irma could have an impact on McDonald's results when the fast food giant reports earnings. The fast food chain has a large presence in both Florida and Texas, but many say that impact could be temporary and are focusing instead on delivery driving sales growth. McDonald's has been testing delivery in the U.S. via its McDelivery partnership with Uber Eats, which is now in 13 countries and 3,500 locations and could positively impact same-store sales growth. There you go.
It has the potential to add maybe a point, maybe 2 points of same-store sales growth in this quarter, particularly with the average transaction size being larger than in-store transactions. That'll be the big number I think a lot of people will be looking for is, what kind of contribution this quarter, and more importantly, what can we expect going forward.
Another thing to keep an eye on are sales performance of newer menu items, including buttermilk, chicken tenders, and the company's continued push into fresh beef in 2018. Last quarter, the company offered an earnings beat thanks in part to discounts on McCafe beverages and sodas. That national value promotion again will be in focus for tomorrow's report.
Delivery, the experience of the future kiosk ordering and mobile order and pay. We need to see validation that this is on track and can be a major contributor in the future. Last couple of quarters, we've seen benefits from these programs internationally, and now it's time for those to start materializing in the U.S.
Also look out for any mention of the experience of the future. Kiosks should be in 2,500 locations by the end of the year, and mobile ordering should be nationwide. For Nightly Business Report, I'm Kate Rogers.
And still ahead, is big tech moving in on the turf of big banks? It turns out that Amazon has received, get this, more than 230 proposals from cities and regions around the country hoping to be the home of the company's second headquarters. Proposals were due last week. Amazon says that tax breaks and grants would be a big deciding factor and that it promises to bring 50,000 new jobs and to spend more than $5 billion on new construction. The proposals came from 43 states, as well as Washington, D.C. and Puerto Rico, 3 Mexican states, and 6 Canadian provinces. So how often do you use cash these days? Probably a lot less than you used to, and that's because more payments are going digital. But it's not necessarily the banks that are leading the way, but instead big technology firms. Deirdre Bosa reports from the Money 2020 conference in Las Vegas.
The future of money. Big banks aren't leading the way, technology companies are. That's why some of the biggest speakers at this year's Money 2020 conference are from Apple, Amazon, and Facebook. Apple's vision of the future includes buying and selling things through the iPhone and sending money through iMessage. Amazon sees you ordering from restaurants using its app and paying with the information already stored in your account. This was all once the turf of traditional banks, but if technology companies have their way, that won't be the case for very long. Tech giants are increasingly moving further into payments, especially as banks lag behind in the development of technologies like cloud computing, artificial intelligence, and big data analytics. It's still early days for tech giants in financial services, but they're growing fast. And a big question, would they want to actually become banks and face the same regulations the banking industry does?
As any one of these companies decides to get into anything from banking to a simpler universe of lending or payments, they have to prepare for the entirety of the business to be impacted by the regulatory oversight. And I think that's a very complex choice.
An Accenture study found that 1 out of 3 consumers globally would consider using Amazon, Google, or Facebook for banking services.
I think big tech represents an opportunity for the banking industry to partner and capitalize on a lot of the innovation that's available in the market that the banks may not have the ability to innovate around themselves.
Yes, they will offer some banking services, but they don't have to be a bank to do that because you have regulations and the regulatory authorities, and the regulations are so strict, it's hard to be a bank.
If you can become a trusted, it's around trust, right? If you can establish the trust with a consumer, and I think both of those have the brands and the depth and the history to actually establish that trust with consumers, and they don't compromise that trust, then absolutely they could become banks, because banks are all built on trust.
Even as companies like Apple and Amazon push further into financial services, banks are relying on them more heavily for their expertise. And it could prove difficult for them to catch up with those capabilities if the competition heats up. For Nightly Business Report, I'm Deirdre Bosa, Las Vegas.
Cisco strikes a deal with BroadSoft, and that's where we begin tonight's Market Focus. The networking technology company is paying nearly $2 billion to acquire BroadSoft, which makes cloud-based communication software. The deal is aimed at growing Cisco's subscription-based revenue and expanding the company's services. Cisco shares closed fractionally higher today to $34.35. Shares of BroadSoft rose more than 1.5% to $54.80. Meanwhile, toy maker Hasbro reported stronger than expected earnings, despite saying the results were hurt by the bankruptcy of its biggest customer, that would be Toys R Us. But the maker of Monopoly, which sold nearly 10% of its inventory through Toys R Us in the quarter, warned that sales in the future would be pressured during the holiday shopping season because of that Toys R Us bankruptcy. And as a result, Hasbro's shares fell more than 8% today to close at $89.75. Under Armour is reportedly considering exiting some of its smaller categories. The Wall Street Journal says that the athletic apparel maker is exploring getting out of the tennis, outdoor gear, and fishing in an effort to combat falling sales. Under Armour also said that its co-founder, Kip Fulks, will take a sabbatical from the company. Shares were off more than 3% today to close at $16.85. Restructuring charges caused profits to miss the mark at specialty metals maker Arconic. The company topped analyst revenue expectations, also lifted its guidance for the full year. In addition, Arconic named former GE executive Charles Blankenship as its new CEO. But Arconic shares fell by 10% finished the day at $24.35. And during a wide-ranging interview earlier today, Saudi billionaire investor Prince Al-Walid bin Talal said that shares of Citigroup could go above $100 and that Tesla's valuation is, as he put it, too exuberant. Mr. Al-Walid runs Kingdom Holdings, a massive conglomerate based in Riyadh. He also floated the idea that Saudi Arabia could list more than 5% of the state oil giant Saudi Aramco in the coming years. But the comments getting the most attention had to do with Bitcoin. He says the cryptocurrency we told you about recently, he told Andrew Ross Sorkin he's not a fan.
I just don't believe in this Bitcoin thing. I think this is going to just implode one day. I think this is Enron in the making.
Really?
Oh, yes.
Enron in the making?
Oh, yes. I just don't believe in Bitcoin at all, completely.
Because?
It just doesn't make sense. You know, this thing is not being regulated. It's not under control. It's not under the supervision of any federal, like the United States Federal Reserve or any other central bank. So I don't believe in this whole thing at all.
Enron, of course, the prince was referring to the massive accounting fraud that took Enron, the energy trading company, into bankruptcy in 2001. And while the Saudi prince and others are skeptical of Bitcoin, it is getting a lot of buzz lately, due in part to its recent surge in value. But it's been slow to take hold as a way to actually buy things. But that may be about to change as a couple of Bitcoin investors use their gains to purchase expensive real estate. Diana Olick has that story for us tonight.
You see it in some restaurants and in some retail. Now Bitcoin is buying into real estate. Over the summer, a Sotheby's agency in Austin was behind the first single-family home sale in Texas involving a cryptocurrency.
So we knew that, Bitcoin's cryptocurrency, it's like any other currency. It has an exchange rate. It can be exchanged for US dollars. So the challenge, which actually wasn't all that challenging, was to figure out who would do an exchange that large.
They turned to BitPay, which did the exchange because the seller, a custom home builder, didn't want Bitcoin. He wanted dollars.
We had a brief amount of conversation about that, but Bitcoin on some level is new to most consumers, so accepting Bitcoin was just not something that they wanted to do.
That will not be the case in Lower Manhattan, where one developer is converting this old rental building into new condos. He has several potential buyers who want to pay in Bitcoin, and he wants to keep the currency.
I think I'll be able to use it both personally and as a developer, but I think it'll become a long-term means to make payment. I've been buying some artwork of recent, and personally for me, I've had a bunch of sellers of artwork ask me to pay them in Bitcoin.
Shaul says that in a hot market like Manhattan, accepting Bitcoin gives him a competitive edge over other sellers.
It's a price point building in the $700 to $1.5 million range. There is not a lot of that inventory in the marketplace. And you try to always work and get one extra edge over someone else, and we think that cryptocurrency and offering that to our buyers is certainly an edge.
It sounds pretty simple now, but the deals so far have been all Bitcoin sales, no mortgage. Bringing Bitcoin to your average neighborhood where most buyers need a home loan will be a much bigger deal, with far-reaching implications not just for real estate, but for banking and borrowing. For Nightly Business Report, I'm Diana Olick in Washington.
Coming up, why this watch is considered the holy grail of timepieces. Welcome back. This watch certainly does more than tell time. It has a history that belongs to the late actor Paul Newman. And the mystery surrounding it could help it become one of the most expensive watches ever sold. Robert Frank has the fascinating story.
Paul Newman was always in a race against time, as an actor, as a race car driver, and as a philanthropist. And now his wristwatch, which some consider to be the holy grail of sports watches, is coming up for sale. And it could become one of the most expensive watches ever sold. Newman's Rolex Cosmograph Daytona will be auctioned off by Phillips on Thursday in New York. Watch collectors say it could fetch between $5 and $10 million, possibly challenging the current highest price for a wristwatch of $11 million. Newman wore the watch every day of his life between 1969 and 1984 and used it to time his car races. It is inscribed on the back with a message from his wife Joanne Woodward with the words, "Drive carefully, me." Now, in 1984, Newman gave the watch to James Cox, who at the time was dating Newman's daughter, Nell. Cox kept the watch and is now selling it, with some of the proceeds going to Nell's charity. Newman made the Rolex Daytona one of the most sought-after watches in the world. Vintage Daytonas, like his, have sold for millions at auction. Now, watch hunters have searched for Newman's Daytona for decades, creating a source of mystery and legend in the watch world. Now the watch worn by Cool Hand Luke is coming onto the auction block, proving once again that Paul Newman is one of Hollywood's truly timeless. For Nightly Business Report, I'm Robert Frank.
And that is Nightly Business Report for tonight. I'm Bill Griffith. Thank you for watching, everybody. Have a great evening. We'll see you tomorrow.